What is a mortgage? A mortgage is a secured loan used to purchase or refinance real estate, where the property acts as collateral. It is a legal contract allowing lenders to seize the property, foreclosure, if the borrower fails to repay the loan plus interest. Mortgages allow homeowners to buy property without paying the full price up front. Key details and usage examples. Purpose: buying a new home, buying investment property, or accessing equity in an existing home. Structure: it is a long-term loan, e.g., 15 to 30 years, with regular, often monthly payments. Types: fixed rate, interest rate stays the same, or variable rate, rate fluctuates with the market. Process: requires a down payment, usually 5% to 20% plus of the home price. Synonyms: related terms: loan, home loan, financing, mortgage loan, secured debt, lion. Common usage scenarios are as follows. Purchasing: they applied for a 25-year mortgage to buy their first house. Refinancing: she took out a second mortgage to renovate her kitchen. Repayment: it will take them 20 years to pay off their mortgage. Defaulting: failure to pay on time can lead to a mortgage default, and the property being repossessed and sold off at a discount for the shark lenders can get their money back. Money matters because your financial education is important. Okay, let's continue. Remember, if you need to go back, listen, learn, recap. Listen, learn, recap. What is a savings account? A UK savings account is a bank or building society account designed to hold money for a specific goal or emergency, paying interest on your balance. Unlike current accounts, they offer higher interest rates and a personal savings allowance, PSA, allowing most people to earn interest tax-free. Common types include easy access, fixed rate, and tax-efficient ISAs. Key features of UK savings accounts. Interest rates: savings accounts pay interest on your balance, calculated daily and paid annually or monthly. Fixed term rate: locks your money away for a fixed period, example 1 to 5 years, in exchange for a higher guaranteed interest rate. Taxation and the personal savings allowance, PSA. As of April 2026, basic rate taxpayers can earn up to £1,000 in interest per year tax-free, and higher rate taxpayers up to £500 under the personal savings allowance, PSA. Individual savings accounts, ISAs. A specific type of account where you can save up to £20,000 per tax year without paying tax on the interest, separate from the PSA. Common types of savings accounts: easy access savings, highly flexible, ideal for emergency funds. Savings accounts usually have limitations on transferring money out, whereas current accounts do not. A savings account in the UK is generally considered a safe way to store cash, but it can be bad or inefficient if used incorrectly, particularly regarding low returns, inflation, and taxes. While top interest rates in April 2026 are still relatively strong, they can fall behind inflation, meaning your money loses purchasing power over time. Here is why a savings account might be considered bad or risky in the UK. 1. Poor interest rates. Real terms loss. Inflation risk. If your interest rate is lower than the rate of inflation, the real value of your money shrinks. Lazy accounts. Many high street banks offer very low rates on standard, instant access savings accounts. Leaving large sums in these accounts for long periods is a loss-making strategy. 2. Tax on savings, personal savings allowance, PSA. If you earn too much interest, you may have to pay tax. Basic rate taxpayers can earn £1,000 in interest tax-free, and higher rate taxpayers, £500. Anything above this is taxed, notes 0.5.3 and 0.5.7.NEED for ISAs. If you have high savings amounts, holding them in a taxable account rather than a tax-free cash ISA is inefficient. 3. Limited growth, not for long-term. Savings accounts are meant for emergency funds or short-term goals, 1 to 3 years. Using them for long-term wealth accumulation, for example retirement, is bad, because stocks and shares typically offer much higher returns over 10+ years. 4. Restrictions and penalties. Fixed-rate locks. Fixed-rate bonds offer higher interest but lock your money away. Withdrawing early can result in heavy penalties, losing the interest earned. Regular saver rules. High-interest regular saver accounts often cap the amount you can deposit, limiting the total interest you can make. 5. Bank failure risk. While most UK banks are safe, FSCS protection covers up to £85,000, per person, per institution, though some sources mention special cases of up to £120,000 in specific scenarios, usually for life events. If you have more than this, it is not protected if the bank fails. Summary of best practices. To avoid a bad savings account. Compare accounts. Use comparison sites like moneysupermarket.com to find the best rate, as rates vary wildly. Use ISAs. Use your annual ISA allowance to avoid tax. Use regular savers. For monthly savings, use high-interest regular saver accounts. Only hold 3 to 6 months. Expenses. Use savings for emergencies. Invest the rest for better growth. Money matters because your financial education is important. This is not financial advice. Please do your own research when it comes to your money.